All right, welcome everyone. This is Bob Maurer. It is Friday, the 9th of May, around about 3:40ish my time. I want to do a deeper dive into two strategies that I introduced recently and give you the backstory on these and make sure everybody's on the same page. So it's strategy numbers 354 and 355. They're both in the oilseed sector. 354 is a bear spread in soybeans and 355 is a bear spread in soy meal. Dialing into the portal, you'll see them on the PDF right here. So 354 Sepnov bean spread, and then 355 the October-December soy meal spread. All right, we got the entries and exit dates, entry and exit prices, and then the risk reward here on the far two right columns, like you already are aware of. So let's hop over to the chart, see how everything's sized up for these two. Also give you the backstory. So what you're looking at right here is the bear spread in soybeans, 354, and in yellow here on the bottom left, long November, short September. So we're in the same marketing year. Okay, the marketing year for soybeans wraps up August 31. So beyond that becomes the new marketing year, which means the new crop. So we're not trading two different crops. We're not trading the one that's in the bin right now on storage and the new crop, which can have a lot more volatility. I mean, these spreads can be volatile too, but we're not straddling marketing years. So long November, short September, same marketing year. Margin requirement 275. Regular entry level, risk reward right here. Regular or average in entry levels, average in entry tactic, risk reward here. Okay, and then if all we do is get level one, you got that right there. Okay, entries and exit points. Well, first of all, let's go over the backstory. So this strategy has been a winner 14 out of the last 15 years. The losing year was 2013. When I size up that chart you're looking at right there with the chart from 2013, I don't see a whole lot of correlation in terms of the incoming price. Okay, this one we came in at -3 cents. I do see some correlation in just in terms of the chart structure. So see how this one is sideways? So was it in 2013. But in 2013, the range from high to low, okay, was a lot wider than what you're looking at there. So it was a much more volatile year. Okay, so that might have been one reason that it became a loser. It was just a pretty wild year. So net, I'm not overly concerned that 2013 scenario would repeat itself in the contract that we're trading. All right. The benchmark stop range. So our benchmark where this seasonal start is -3 cents. Our stop is way up here at 8 cents. That is an 11-cent range. That's $550. That would have been more than enough 14 out of the last 15 years. So we should be giving this ample room. The one year that it wouldn't have worked out was that 2013 that I mentioned, which was the losing year. And at one point, the market was losing, or this strategy was losing $1,400. So we're risking 550. That should be plenty because the average risk that you would have had to take to stay on board with this was about 375. Okay, so I like the amount of risk that we're giving. I like that it keeps all the risk reward manageable. And that is the backstory on this one. So our entry levels are even money and the nickel. Stop is at 8 cents. Targets are -6 and -7. This market is primarily in a trading range, sideways trading range, somewhere in that neck of the woods. So we are looking for this thing to stay range bound, rotate back up to the high end of the range, and then rotate back to the downside. Okay. So test the high and then retest the low. And that would align nicely with our seasonal window, which projects for a lower close than where it started. And it started at -3. So anywhere south of -3 would be a winner. All right, so that is strategy number 354, bear spread in soybeans. Everybody should be on the same page and you understand the backstory. Now let's look at its cousin, soy meal. So when you crush a soybean, you get bean oil and you get soy meal. So these are going to be related. So if you're looking for diversification, you might not want to do both of these. It's totally up to you, though. So this is in yellow, strategy number 355, bear spread in soy meal, long December, short October. So for soybean meal, the marketing year ends later, 1 month later than soybeans. So the marketing year ends September 30th. So we're doing October. So Ocdisa, the same marketing year. It's going to be new crop. All right, so a little more conservative than that. We're not straddling marketing years. Margin requirement 220, so similar to the soybean. And then risk reward levels are right here on the bottom. The backstory on this one, it's been a profitable strategy 14 out of the last 15 years. The one losing year was 2015. In 2015, I don't see a whole lot of correlation in terms of the incoming price. We're looking at negative 280 is where this one started. And in terms of structure, they do look similar in as much as this one has kind of been drifting lower. So was it in 2015. So 2015 also drifted lower, but it had about 2 times the trading range. So it was a much more volatile market than we have. So therefore, I'm not overly concerned that 2015 would repeat itself, that losing year. Is it possible? Of course. I can't completely discount it, but at the same time, I don't think there's enough of a correlation to warrant us looking off this trade, and I like the back data. Benchmark to stop range. Benchmark was negative 280. Stop is negative 120. So that's 16 or equals $160. That would have been enough to stay on board 10 of the last 15 years. One note, though. This has been a pretty quiet market. So when I do my analysis, one thing I look at is relative volatility. And if the relative volatility of the market going into the seasonal for the contracts will be traded, so like what you're looking at here, nice steady lower move, prices are not super wide. I would adjust previous years accordingly. So even though we're not giving this enough room from our benchmark to our stop level to say that we would have been able to stay on board 15 out of the last 15 years, once I adjust the relative moves based on how the markets were coming into the seasonal, according to the spread that you're looking at in front of you there, then it kind of tightens things up a little bit. So hopefully you follow that logic. So I do basically a range adjusted, volatility adjusted analysis of previous moves within the seasonal window. Okay, so I kind of compare how things are either much more wild or much more quieter, putting it easily, than they had been in years past, and I make adjustments for that. So it doesn't seem like we have enough room to really stay on board if we're only doing 10 out of the last 15 years, but based on those adjustments, I think it should work. All right. And if anything, it just helps us tighten the risk. So that's where we're at with that. If you have any further questions, let me know. But our stop is up here at negative 12 and our target negative 42. So we're looking to sell a rally. Primarily, it's range boundish, somewhere like that, I guess, right? It used to be up a little bit, maybe up about another 30, 40 cents, and now it's come down a bit. So we want to see this thing pop up, take out these recent swing highs, and then fail on back down. All right, so that's what we are looking for with this particular strategy. So already started moving the way of the seasonal. It'd be nice if we were on board, but we are looking to get in up here at negative 20 and negative 17. So we will sit patiently on the sidelines. If it just breaks on down, we might rethink this one. But for right now, we're going to stay with it. All right, so no fill, no change to the strategy at the moment. Alrighty, so those are strategies number 354 and 355, both in the oilseed sector. If you have any questions, comments, anything of interest about those two, feel free to let me know. I am going to leave it there, and thanks so much for watching.